What if the most powerful economic institution in America is under attack? Not from a foreign enemy, not from a financial collapse, but from inside Washington itself. Right now, the Federal Reserve is facing a criminal investigation so unprecedented that it's already rattling Wall Street. Markets are reacting, the dollar is slipping, and behind closed doors, officials are preparing for a fight that could reshake interest rates, economic growth, and the future of the U.S. economy. Because this isn't just about the Fed, and it's not just about politics. If this battle escalates, the shockwaves could reach straight into your wallet faster than anyone expected. It began quietly, but the impact was anything but. Late last week, the Justice Department issued subpoenas directly to the Federal Reserve, a move so rare that even veteran Washington insiders were caught off guard. This wasn't a routine oversight request. This was a criminal investigation aimed at the very institution that controls America's interest rates. Almost instantly, shock rippled through Wall Street. Traders froze. Analysts scrambled because the Federal Reserve has always operated behind a wall of independence, shielded from political pressure, and now that wall appeared to crack. Then came Jerome Powell's response, and that's when this story took a dramatic turn. Instead of staying silent, the Fed chair went public. In a rare written statement and an even rarer direct-to-camera address, Powell accused the investigation of being built on a false pretext. According to him, the real goal wasn't accountability, it was pressure. Pressure to influence interest rate decisions. That moment changed everything. What could have been dismissed as a legal dispute instantly became a full-blown institutional showdown. And as the Fed dug in its heels, one thing became clear. This wasn't going to end quietly. Almost immediately, Wall Street started to feel the tremors. Analysts began warning that this legal showdown could completely freeze the Fed's plans for interest rate cuts. Just weeks ago, investors were expecting one, maybe two reductions in 2026, enough to ease borrowing costs and stimulate growth. Now that outlook was collapsing. Reports claim that major firms, including J.P. Morgan, are predicting the Fed could hold rates steady throughout the entire year. No cuts, no relief. For traders betting on cheaper loans in stronger markets, it was a nightmare scenario. And the anxiety doesn't stop at financial charts. When the Fed pauses or delays cuts, every corner of the economy feels it, from businesses hesitant to borrow for expansion to homeowners watching mortgage rates climb. Wall Street may be the first to react, but Main Street could end up paying the price. The question everyone is asking, if the Fed is under this kind of scrutiny, can it make decisions based purely on economic reality, or will fear of political backlash start dictating policy? And what happened next shocked even the most seasoned analysts. Just when it seemed the Fed might be cornered, Jerome Powell made a move that no one saw coming. His term as chair is set to end in May, but reports now suggest he may not step aside. In fact, some analysts say Powell could remain on the Federal Reserve's board or even stay on as chair longer than expected to protect the institution during this unprecedented investigation. Senators from both parties are adding fuel to the fire. Tom Tillis, R. North Carolina, and Elizabeth Warren, D. Massachusetts, have openly suggested blocking votes on any new Fed nominees until the investigation concludes. That means the current leadership, including several Biden-era appointees, could remain in place far longer than anyone anticipated. This potential extension isn't just a matter of titles, it could shape the future of U.S. interest rates. With Powell and other board members staying put, analysts warn that the committee responsible for monetary policy may favor caution over cuts, keeping rates higher for longer. And that's a reality that could directly affect everything from mortgages to business loans. Powell isn't just defending himself. He's playing a strategic game to safeguard the Fed's independence. But in doing so, he's also signaling to the world that this fight is far from over, and what comes next could change the rules of American finance entirely. And then there's the elephant in the room, Donald Trump. For years, Trump has criticized Powell for being too slow to cut interest rates, arguing that high rates were holding back economic growth. Ironically, Trump himself nominated Powell back in 2017, praising him at the time as the right choice for the Fed. Now, the relationship has soured dramatically. With the investigation unfolding, Trump is expected to nominate a new Fed chair, someone who would likely push for faster, deeper rate cuts. But that plan may be blocked entirely as senators delay confirmations while the probe continues. Rumors suggest this standoff could leave Powell in place longer than anyone imagined, frustrating Trump's monetary agenda. It's a dramatic reversal. The president who once endorsed Powell is now watching him stand firm against political pressure, potentially reshaping the Fed in ways Trump never intended. And as the legal and political tension mounts, Wall Street and Main Street are left wondering who really controls U.S. monetary policy. But while Trump and Powell clash on the national stage, the stakes for everyday Americans are quietly rising. The investigation itself is as unusual as it is high stakes. Reports claim the criminal inquiry centers on Powell's prior testimony to the Senate regarding cost overruns tied to Federal Reserve building renovations. On the surface, it sounds like a technical matter, but Powell insists it's a false pretext, an excuse designed to pressure the Fed over interest rate decisions rather than address legitimate oversight concerns. In his own words, the threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. That statement alone sent shockwaves through the financial world because it frames this probe as a direct challenge to the Fed's independence. Rumors suggest that the DOJ's focus isn't just about Powell or the building renovations. It's about sending a warning to the entire institution: fall in line or face consequences. And if that message sticks, it could fundamentally change how the Fed operates, turning what has always been an independent central bank into an entity guided by political pressure. But for now, Powell and the Fed are digging in. They're taking a stand that could define the boundaries of U.S. monetary policy for years to come. And what happens next won't just affect the elite on Wall Street, it could ripple across every American's bank account. This isn't just a fight for the Fed or a battle on Wall Street. It's a story that could touch every American's wallet. Interest rates aren't abstract numbers. They determine how much you pay on your mortgage, your credit cards, car loans, and even business loans. When the Fed keeps rates high or delays cuts, borrowing becomes more expensive. That means families could struggle with bigger monthly payments, and businesses might put hiring or expansion plans on hold. Analysts are already warning that fewer rate cuts this year could slow economic growth and tighten the labor market. Jobs might not grow as quickly, and wages could stagnate, all because monetary policy is being influenced by political tension instead of pure economic reasoning. Even small decisions at the Fed ripple out to Main Street. A higher interest rate today might mean a pricier mortgage tomorrow, more expensive loans, and less money for everyday spending. This legal and political battle isn't happening in some distant office. It's playing out in your bank statements, your paycheck, and your plans for the future. And as the Fed braces for what could be a drawn-out showdown, Americans are left asking, will the central bank act in the best interest of the public or bow to political pressure? What happens next will affect everyone. The stakes of this showdown aren't just domestic, they're global. Almost immediately after news of the investigation broke, the U.S. dollar began to weaken. A softer dollar makes imports more expensive, meaning everyday goods cost more. It also reduces the value of U.S. exports abroad, potentially hurting American businesses and slowing economic growth. But the ripple effects go even deeper. Economists warn that any perception that the Federal Reserve is losing its independence could shake global confidence in the U.S. economy. The Fed has long been viewed as a steady hand, guiding the world's reserve currency and maintaining stability for investors worldwide. If that trust erodes, it could unsettle financial markets from Tokyo to London. In a rare joint statement, every living former Fed chair, along with several top economic officials, called the investigation an unprecedented threat to central bank independence. That's not just dramatic language, it's a warning that political pressure on the Fed could have lasting consequences for global markets, the dollar, and even America's role as the world's economic anchor. As nations and investors watch closely, one question looms. If the Fed can't act independently, who can? And how far-reaching could the consequences be? The world is watching, and it may be Americans who feel the shockwaves first. What's happening at the Federal Reserve isn't just a legal battle, it's a warning about the future of American economic independence. If the Fed bows to political pressure instead of acting on data and economic reality, the consequences could be severe. Mistimed rate decisions could fuel inflation, slow growth, or destabilize markets. Trust in the U.S. dollar, the backbone of global finance, could erode, and once confidence is lost, it's impossible to get back. This unprecedented showdown between the Justice Department and the Fed sets a dangerous precedent. No institution, no matter how powerful, may be safe from political influence. The rules that once kept monetary policy impartial are being tested like never before. For everyday Americans, that means higher borrowing costs, slower economic growth, and uncertainty that touches everything from your paycheck to your retirement plans. The question now is chilling. If even the Federal Reserve can be pressured, what does that mean for the future of American democracy and the stability of the economy itself? The outcome of this fight could redefine not just interest rates, but the very way the U.S. governs its financial future.